I spent the last 30 days doing nothing but researching stocks. I didn't just look at tickers, I read one OK's analyzed balance sheets and listened to boring earnings calls so you don't have to. My goal? To answer one simple question: is picking individual stocks actually worth the effort for a beginner? Or are we all just gambling? The results were honestly shocking. I found three major patterns that separate the winners from the losers, and one massive mistake I almost made that would have wiped out my portfolio. Let's break down exactly what happened. Day 1 started with a reality check. I thought stock research was about finding the next Nvidia or Tesla. Spoiler alert, it's not. I used a process called fundamental analysis. For those new to the stock market, for beginners, this means looking at the business, not just the stock price. I set up a filter for companies with growing revenue, low debt, and crucially, a competitive advantage. Out of 5,000 potential stocks, my screener killed 4,800 of them instantly. This was my first lesson. 90% of the market is noise. If you're trying to find a needle in a haystack, bring a magnet. Focusing on strong fundamentals is that magnet. It helps you ignore the hype and concentrate on what truly matters for long-term growth. By day 15, I had narrowed it down to 10 companies. Here is the exact framework I used to vet them. You can steal this for your own research. First, the moat. Does this company have something others can't copy? I looked at a tech company that seemed great, but realized Google could replicate their entire product in a weekend. Result? I tossed it. A strong moat, like a brand name, patent, or network effect, protects a company from competition. Without one, even a great idea can get crushed. Second, the numbers. I looked specifically at free cash flow. Revenue is vanity, profit is sanity, but cash is king. I found a retail company with high sales, but they were burning cash just to keep the lights on. That's a trap. A company needs to generate more cash than it spends to be a healthy, sustainable business. Don't be fooled by impressive sales figures. Dig deeper into the cash flow statement to see if the business is actually making money. It's a non-negotiable step. Third, the management. This is where investing for beginners gets tricky. I listened to CEO interviews. Were they honest about their struggles? Or were they just selling a dream? I found one CEO who sold $50 million of his own stock right before bad news dropped. Avoid these red flags like the plague. Honest, transparent, and shareholder-aligned leadership is critical. You are essentially partnering with these people when you buy their stock, so make sure they're trustworthy. Around day 25, I almost messed up. I fell in love with a stock. I spent so much time researching it that I ignored the risks. This is called confirmation bias. I was convinced this I stock was the future. But when I looked at their valuation, it was trading at 100 times its earnings. I realized that even if the company did perfectly, the stock price was already priced for perfection. If I bought it, I was gambling, not investing. That's the biggest finding of this 30-day experiment. Good companies can be bad investments if you pay too much for them. The price you pay determines your return. So after 30 days, did I find the perfect stock? I found two, just 2 out of thousands. And that's okay. If you want to survive in the market, you have to say no way more often than you say yes. Investing isn't about action. It's about patience. You don't get paid for trading. You get paid for waiting. It's about discipline and sticking to your criteria, even when it feels like you're missing out. If you want to see the deep dive on the 2 stocks I actually liked, let me know in the comments. And if you want to learn how to analyze a balance sheet in under 60 seconds, check out this video right here. Thanks for watching Future Finance Lab. Think long term, and I'll see you in the next one.